Okay, Joe, thank you very much for laying it out so clearly. We'll open up to discussion. I want to start with one question, which is really methodological, but I think raises some key policy issues. You focused in your book on the volatility of exchange rates and their potential costs and benefits, as you argued it. But when I've dabbled on this in the past, when John Williamson and others here have worked on it, the focus has been not on volatility, but on misaligned levels of exchange rates. And John's here, he can speak for himself, but when you referred to his reference rate proposal at the end, you characterized it as aimed at reducing volatility of rates, whereas I think his goal was to limit deviations from equilibrium rates as he defines them in terms of levels. John may want to elaborate on that right now, elaborate the question, but what I'm really posing to you is a methodological question. How do you distinguish between, on the one hand, volatility of rates, and on the other hand, prolonged levels of misalignments vis-a-vis underlying variables of the type John and I have talked about in the past, and which do you think is more important, or how do the two concerns interact with each other? But John, go ahead and elaborate, and then we'll ask Joe to respond to that.
As I understood him, Joe in fact used the term long-term volatility in the same sense that I was using misalignments. Now, maybe that's wrong, Joe, and there's a distinction, but if that's the solution, it's just a semantic difference.
Well, thanks, John. In fact, that is correct. I think of, when I say volatility, again, I'm talking about these large, sustained deviations from where we think equilibrium in the long run is. So in that sense, I think it is quite similar.
And so, but then follow that through. So your conclusion is that floating rates essentially minimize the long-term deviations from what John has called misalignments.
No. I think floating exchange rates allow those to happen. They have happened, and that's of course what gets people concerned. What I've said is that attempts to minimize those by monetary policy are harmful. That we don't really have a good tool. We could try to use foreign exchange intervention a little bit. That's what I ended up on. I don't think we should have a lot of hope that it will make a huge difference, but I think it can help at the margin. But I think if you hijack monetary policy away from domestic stabilization to deal with that problem, I think it's harmful. I think that is sort of the message, that it's sort of a cost that we have to live with because the alternative is worse.
Okay, let me draw one more inference from that, because I know in other contexts you have inveighed against the Chinese intervention, for example, to maintain an undervalued RMB. Your thrust is to avoid devoting monetary policy to exchange rates, but what's your sense on other strategies like China's that, in some sense, preserve big currency misalignment? And again, I'll come back to the confusion, and maybe this is terminological, but between stability and misalignment. Certainly, the Chinese exchange rate over the past 5 years has been quite stable against the dollar. And the Wall Street Journal, in its editorial yesterday, said how great that is. But some of us have thought that stability was purchased at an important price, and I know you share that view. So sort of elaborate then on other measures than monetary policy that may cause, in John's terminology, prolonged misalignment, or in yours, excessive volatility.
Okay. Yeah, I think the Chinese approach, which I think is more than just China. China may be the leading example, but it's actually widespread in developing countries now, is a new development. And I think it sort of has, in many ways, it sort of separate from the main point of the book because it can only persist as it has in countries that don't have free and open capital markets, which is really the main focus of the book. But I guess I do agree with you. Yeah, China has stabilized the exchange rate at a level that seems not consistent with long-run equilibrium. And there, you're right. In that case, it's stability that is harmful stability in some sense. I guess the question is, how long can they continue with that? Internal inconsistencies, internal costs are already building in these countries that may limit the strategy over time. But it certainly has gone on for 10 years now, and it does have externalities for the rest of the world that I think I'm concerned about. I'm not sure. So whether you call that volatility or whether you call it misalignment,
But just on the terminological point, I mean, it does seem that what China has practiced produces stability in the exchange rate, at least vis-a-vis the dollar, not so much on a trade-weighted basis. In that sense, I must admit, I find it more useful to think in terms of misalignment than excessive volatility.
Yeah, no, I would accept that, yeah.
All right, Joel. Okay, please introduce yourself and then fire away.
I'm Michael Klein, also known as Joel.
I don't know why I called you that.
That's okay.
That's a different Klein.
Yeah, I'm a chief economist at International Affairs and Treasury. Maybe, Joe, a way to think about this is that you would like to have flexible exchange rates to provide a stable world economy. So it isn't the stability as much as if flexible exchange rates allow for an equilibrating mechanism. So what are your thoughts about whether or not flexible exchange rates could provide for an equilibrating mechanism? On the one hand, you show there's a lot of volatility that might be endogenous, but on the other hand, we have this example of China where stability is not synonymous with equilibrium. So what are your thoughts about if flexible exchange rates could provide for a more stable world economy?
Well, I think that would presuppose a world in which governments allowed the market to operate, which clearly China is not doing in this case. I think, so leaving aside the sort of Chinas of the world now, and going to a world in which countries did let the market operate, can it be a stabilizing mechanism? Well, I think that was the hope of most economists back when we launched the flexible exchange rate system. We thought, oh, well, the market will endogenously stabilize, lead to stabilizing exchange rate behavior, and that will be good. And I have to say that I don't think that history bears out that happened. Now, I don't fully understand why, and I think that's the whole issue of what these risk premiums are. I mean, the risk premium is just a term I'm using for something we don't understand well. And it seems to be, in itself, a bit destabilizing. But the point of the book is, well, tough. We're in a world in which exchange rates should be stabilizing, but they're not. But you know what? It's still better to let them do their thing than to try, as China's done lately and other countries have in the past, to stabilize them at a value that ends up causing more harm down the road. So in that sense, I would like the world to be the way that you mentioned, but I think reality has to tell us it hasn't been. Now, the point about the reference rate and how I came to John Williamson's reference rate idea at the end is actually, well, one thing that central banks could do a little bit to help at the margin is maybe to use intervention as a signal to the world when they think the market has it wrong and when they think the free market has chosen the wrong equilibrium, and to try to nudge it, sort of this idea which is popular these days of nudging things, right? You nudge it in the direction you think is right without putting all your credibility on the line, without drawing a line in the sand to defend. Just saying, well, look, we think at this price, the exchange rate's a pretty good buy, we're going to buy it, right? And if you do that over many years and you're successful and you make money, maybe markets will come to believe you more. Maybe markets will come to respond, and then maybe they will move to more stabilizing.
Yes, Karen?
So I'm just wondering, Karen Johnson, consulting economist. Joe, I'm just wondering what you would say if you were at a meeting of the Swiss National Bank Policy Board. Because they've had lots of experience with floating rates. They seem to think they need to abandon a monetary policy that's directed at domestic objectives and actually peg the exchange rate at this point. They just have it wrong? Do they not know their own interests?
Well, thank you, Karen. I knew someone was going to ask that question. I mean, it was just too obvious.
Thank you, Karen.
No, but sadly, I wish I had a better answer. We are now at this new world of the zero bound on interest rates, which wasn't the case in any of the time periods that the book looks at, really, because it's just too new. If you think that the zero bound on interest rates is a limit to monetary policy, then what the Swiss have done is a logical step. But it does have regrettable beggar thy neighbor consequences for its neighbors who are also at the zero bound. And so what I would like to see, and what I think is possible, and this is an area that I'm actually working on for new research, is showing that maybe central banks have other options, even at the zero bound. They can print money and buy other assets besides short-term bills and bank deposits. And now the Swiss bond market isn't very big. In the U.S., Fed's gone into the bond market. But perhaps central banks should think about equities or other assets that have other characteristics they can operate on. I'm not sure. Maybe Switzerland's unique because it's so small and has such a quirky financial market, but a big financial market, but for a small country. Maybe Switzerland has no choice. I don't have a good answer for Switzerland, but I would like to see if they could have them operate through the bond market that they do have to the extent that they can, operate through the equity market to the extent that they can. I think buying other countries' assets in this day and age is feeding the currency wars.
Yeah, Bill?
Joe, you know, a potentially explosive implication of your table on page 183, and you have the chart. It seems to say that the Euro member countries made a mistake to form the Euro because it gave them more volatility in their nominal growth rate than their comparators. I mean, the reality behind this, since you go through 2010, surely, I mean, if you did just up through 2007, you probably wouldn't get it, or you might not get anywhere near the same, because the economic thing we've been observing is the difficulty of the countries that can't get the growth from devaluation now. So that's going to show up in the last couple of years. But I guess the question sort of is, do you really mean to conclude that? A, and B, how do you get a metric that goes from nominal output value volatility to welfare? I mean, can you say that what Europe did by going into the euro was the equivalent to a permanent loss of X% of GDP? And maybe you could look at it sort of like an environmental good. It was worse for them to spend that, to have solidarity. Anyway, I'm trying to tease out, right, this inflammatory implication that the euro was a mistake.
Well, I think, you know, I'm not one to discount political motivations for doing things. I think they're valid, and I think that a lot of the benefits of the euro have to be in the political sphere, and I don't know how to value that. But what I would say is that this table is not that sensitive to the last 2 years. So you could chop off. In fact, I've a new work that's actually motivated by this table, but I've taken beyond the book now. I'm looking at sort of the internal coherence of the euro area, and even if you look up to 2007 and cut off the last 3 years, you find broadly similar results. A little less extreme, but but not, it still is the case that Europe is giving up something to be in a currency union. So you can argue about how much that is and whether the political benefits justify it, but on pure economic grounds, it does seem that Europe has given up something.
Yes.
Thank you. Yuan Ye, Voice of America. Dr. Gagnon, the increased fiscal cost that comes with currency intervention that you talked about in the presentation, do you think that also applies to China, given that the interest rate is more or less artificially set? Thank you.
Well, actually, I do think it applies to China, and I saw a recent piece by an investment bank economist who estimated that China is now losing $110 billion a year in net interest cost by borrowing in China. At the margin, the People's Bank of China borrows at a 3.5% rate, I believe, and it's earning about 0.2 on its reserves. And even if you don't factor in the fact that China is losing in the value of those reserves in terms of renminbi, just the negative carry is worth over $100 billion a year, according to this economist. I haven't had time to check that number, but with $3 trillion of reserves, something like that could be true, and certainly will grow over time. So yeah, no, I think it could begin to be a significant fiscal cost, a few percent of GDP.
So that's the cost of the export subsidy and subsidy to import competing industries that is not shown on the books anywhere and is therefore a convenient policy device. But I'm sure to the extent they think of it that way, that's the imputed cost of the export and job subsidy that's generated by the undervalued currency policy. It's nice to have a partial quantification. Pat?
I was recently in, is this on? Okay, I was recently in Hong Kong and I read an article in the newspaper over there that Dr. Burton had said that China's undervaluation of its currency over the years has been the biggest protectionist racket, I think something like that, in world history. And he said in this article that I read that the Treasury should name China a currency manipulator under U.S. law. Under U.S. law, if a country is underpricing its currency to gain trade advantage, you're supposed to cite them. Why do you think Treasury has failed to cite China? And if you were there, what would be the consequences, do you think, if we did cite China?
Well, I don't want...
I'm watching.
I really don't want to ascribe motives to why people might do what they do, but I don't see how you can not label China a currency manipulator. I mean, if China isn't a currency manipulator, then I don't think the term has any meaning whatsoever. It's ridiculous. What would I do? Well, I think, Fred might want to chime in after me, but I think, so let me digress a bit, but not too much. But the IMF has done a whole bunch of work recently on why countries might want to have capital controls and when might they be useful. And if you look at the checklist they set up for when it might be useful for a country to impose capital controls, and go down that list, there's one country that stands out as fitting the bill more than anyone I can think of, and that's the United States. And so I suggest we might want to tax capital inflows from China, and possibly all capital inflows. But if we don't think we can just limit it to China because they could hide, then maybe we need to do it on everyone. But I would like to do it first on anyone who's a manipulator gets their investments in the U.S. taxed.
Bill.
I'm Bill Helke, a former colleague of Joe's at the Federal Reserve. I found one, which I think was well-known, observation you had, which is when you had the flexible exchange rates, you had more stability in economic output than you did with fixed. And I can recollect a little bit, I'm not a historian, that when you had less flexible financial markets and you had shocks to the economy, the shock absorber was a real economy, which caused a lot of unemployment, which was not a good thing, right? But the other thing I noticed, other than which I've noticed, and I think if you looked at it more, not only have exchange rates been more volatile over this period, but so have other asset prices, right? Okay? So it appears to me that with floating exchange rates and asset prices, you're going to get more volatility there, but that's where you want it. Okay, and that comes from at least the way I think about macro, which is the macroeconomy is pretty stable except when hit with shocks. Okay, shocks I don't think are going to go away, and even if they aren't going to go away, they're unforecastable. So it might be interesting to take that and say, well, why do we all of a sudden have this big decline in real activity? And that's because one of the, which Fred has heard from me before, is one of the economies on fixed exchange rates has now gotten very large. Okay, and that's enough to affect the rest of the world. So I think it'd be worthwhile, if you do anything else in this book, to kind of look at the volatility of all asset markets and kind of approach it that, hey, you know, the volatility and real activity before came from shocks. Now these asset prices are the shock absorbers.
I think that's a good point, Bill, and I think I could stress even more, you know, that this volatility in exchange rates is not something we don't see in other financial markets. We do see in other financial markets, and it's a puzzle in every financial market.
Exactly.
Yeah.
Because they're now the shock absorbers instead of the real economy. And when you didn't have developed financial markets at fixed exchange rates, the shocks went to unemployed resources, which is not something that we want.
Right. So one thing I would add, though, is it's not just one country. I mean, I don't want to say it's only China. A lot of countries are following.
All managed guys, right?
But a lot of countries are following China, at least, if not. And whether China would stop and they would stop, I don't know. But in terms of this reserve accumulation, China's only a little less than half. So
the definition of a managed exchange rate is if you're accumulating reserves.
Right, and so China's not the only one.
Exactly, and there's even some developed economies
Yes.
that have gone some reserves, which means whether you think they're intervening or not, they are, right?
Okay, more questions? Yeah.
Charlie Thomas from the Federal Reserve. I'm just a little confused in that talking about the shocks to the real exchange rate. Not so long ago, we were just thinking of the movements in the real exchange rate as part of the channels for monetary policy, right? So you have monetary policy does its thing, but when you have flexible exchange rates, it gets reflected in the exchange rate. And it's through those movements that you get the impact on the real economy, getting what you want your monetary policy to do, right? So it seems like you've, or at least in some of the discussion, it's been framed as, oh, and then we've got these other things that are knocking real exchange rates around. But maybe I'm behind, but I was still thinking of it as a part of the general channel coming from monetary policy.
Well, no, I hear you, Charlie. And I didn't have time, but the book talks about it. I mean, in the model where I used to explore how these things work is, in fact, the kind of channel you're talking about, how exchange rates do respond to monetary policy in the way you would want them to through the interest rate parity conditions. But when I talked about real exchange rates and shocks, I'm just making the actual empirical point, the sort of data-based point, which is that if you look at real exchange rates and say, well, what is driving them, and you include those monetary channels, right, those don't explain much. In fact, I mean, and they're there, and if monetary policy wanted to use them strongly, it would work. But in practice, in the real world, they haven't been the dominant source of shocks. It's actually been these other things called risk premiums that just as a practical matter have been larger. But it's not to deny the channel.
In fact, let me push a little further. I'm glad you raised that because I've had an observation on this analysis over the years, and tell me if it's wrong. I think it used to be, 10 years ago or more, that most of the staff studies coming out of the Fed treated, as you suggested, the exchange rate channel as one of the standard channels for the transmission of monetary policy into the real economy. In recent years, I have seen very little of that. And to be honest, I thought that was just a cover-up or political correctness, because there have been charges that the U.S. is trying to, talk down the dollar or competitively devalue or whatever. It's a little hard to square with our huge growing current account deficits and position as the world's largest debtor country. Nevertheless, the charges were made. And so I assumed just the Fed was talking about it less, though still believed that the exchange rate channel was one of the standard mechanisms for the translation of monetary policy changes into the real economy. So which is correct? I'll ask Joe, but there are many Fed colleagues here. Is the exchange rate channel still viewed as one of the standard mechanisms in that respect? And if so, why has there been less, if I'm right in my observation, less attention to that in recent years?
Well, I guess my Fed colleagues probably aren't best placed to answer, but let me try to answer for them what I think they would say, which is that yes, that mechanism is clearly there, and the Fed, as I think you guessed, not just for these recent international reasons, but for domestic reasons, we always say the Treasury Secretary speaks for U.S. exchange rate policy, and the Fed chairman has found it convenient to adhere to that line. So the Fed doesn't like to highlight these channels, but absolutely they're there.
You also probably don't want to be hammered by the editorial pages of the Wall Street Journal for competitively devaluing the currency.
And by the way, I might add that, as the book quotes, every time the dollar devalues, the Wall Street Journal hammers the Fed for the inflation on the way.
Debasing the currency.
Yeah, debasing the currency. And at least in the past 25 years, it's never happened. So they've just been wrong repeatedly, and they don't seem to learn.
No, they don't. Over here. Yeah, Antonio.
Antonio de Lecea, European Union delegation to the US, and thank you for the insightful presentation and the book. You will not be surprised that my question is on the euro. And on the table on page 183, and it's twofold. One is that comparing the volatility or the standard deviation of nominal GDP of the euro area countries and those of the advanced countries is somewhat misplaced, to the extent that that within the original euro members there are economies that are well advanced, so comparable to the advanced countries, but there are others that are catching up. And you wouldn't expect the same degree of stability with those than with the others. The second is that you seem to attribute too much weight to the exchange rate system when accounting for this volatility. And we know that the euro was not a substitute for good fiscal policies, and this certainly and other policies and structural reforms. There were many differences within the euro area countries, and which, in my opinion, have much more bearing in explaining these differences than just the exchange rate. So drawing the consequence that they were in the euro or outside the euro for explaining the growth differences, I think is slightly overdone.
I think those are fair points, but I would note that part of, if countries are having divergent fiscal policies, then that's sort of all the more reason why you'd want them to have independent monetary policy to offset that. So I still think that's the price that Europe has paid. I'm not saying it's not worth it. I'm not a Euro skeptic in the sense that I was ever against the Euro or thought it would fail, but I just think it's unavoidable that this isn't just a free lunch. You don't, it isn't an unallied blessing. It has a lot of elements that are positive and very politically beneficial, but not without some cost.
Patrick, you got another one?
You mind if I ask one more? I saw when the vice president was in China, he was expressing gratitude for the Chinese for buying our treasuries, and said, don't lose confidence in them. Do you think if we name China a currency manipulator, is that a factor that we have to be worried about, that they won't buy our treasuries? Or is that an overblown concern by people who don't want to deal with this problem? I just need some sense from a person like you, or maybe even Fred, to comment on that point.
Well, so this is something I feel quite strongly about. The last thing we want is for China to buy our treasuries. We don't need them to buy our treasuries. Not only do we not need them, we don't want them to buy our treasuries. This is the problem. That is the problem.
Amen. We want them to adjust, not finance, in terms of the typical twofold responses to imbalances. Okay, thank you all very much. Joe, thank you terrifically. Appreciate it. Meeting adjourned.